Hello and welcome to this Twitter live chat that me, Vivek Law and Surya Bhatia is having with you. This is the Money Mile handle and you're welcome to send in any of your personal finance questions, any queries you may have, any doubts you may have. Surya is here to answer them. We've received a few questions from some of you over the last few days and weeks, and we intend to take some of them. But if you have any other question, type away, write away, and we'll be happy to take it right here on the Money Mile. Finn Bouquet asked this question, Surya, what are the returns on ULIP policies? There's a lot of buzz around the new age ULIPs these days, and I think it's important to differentiate and spend a little time telling people what these are vis-a-vis the earlier, much maligned ULIPs, which came with a lot of charges and a lot of costs. But on a return to return basis, have they pretty much been at par with mutual funds?
I think, Vivek, they're really catching up now as far as the returns on ULIPs are concerned. But the only challenge when you talk about ULIPs, yes, where we have been around 10-15 years back on ULIPs when they were actually launched in India, that's I think good 15 years back, and now which is so-called the 4G ULIP plans, which are the new avatar of the ULIP options you carry. Definitely, they have actually come a long way. The charges have come down a lot. And they are now, I think, to a certain extent, in some cases, are even better off than your normal mutual fund. The challenge still remains on the liquidity factor. But talking about a pure returns perspective, I think you should do a comparison of these net of charges, net of expenses. That's what really matters to any investor when you talk about the returns, because that's what really comes in your hand. So if you look at a performance perspective, you have to look at different options available like a mutual fund in ULIPs also. So you have a debt category, you have a balance category, you have an equity category. Of course, ULIP calls it by different names. Someone call it maximizer, allocator. So different names kind of float around by different companies. So you have to first kind of understand the jargon being used by these ULIP plans, that what are the real plans they are offering you, because it's not very synchronized when you talk about the options available in the ULIP plans. So you have to compare a large cap with a large cap, diversified with a multi-cap strategy, mid cap with a mid cap, bond with a long bond or a short bond, liquid and so on and so forth. So once you do a comparison and then you look at the indicator, you will actually find that performance of some of them are really now catching up with the mutual fund performances. But yes, because you have the legacy when the charges are very high, you don't find the returns happening in the same order. But that's primarily also because of the huge debits they have on the expense ratios they carry. That will still take some time before they really do a real comparison of the same. But yes, if you look at a shorter duration now, you're actually saying they're actually coming close to it, but they'll still take some time before you really find the comparison, because now these new plans, which actually have come in the offering only in the last few months, Vivek, you find them really competitive and in line or even better than a mutual fund. So going forward, you will find these charges being mitigated and the true comparison coming off. But yes, there is surely an improvement happening over there.
Okay. There is a question that we've got from Harjot underscore Singh, who asks, I invested in a consumer sector fund, that is the Tata Consumer Fund, which was giving me very good returns for about 13 months. But now it has gone into negative returns after the markets went down recently. What should I do? Redeem or hold on to this fund?
Let's break this query into few separate small queries on this, Vivek. Mr. Harjot, you are talking about a fund which is sectoral call. It's not a pure sectoral call, it's more of a thematic fund because it doesn't invest in one sector, it invests in one theme, which is a consumption theme, which is consumer oriented scheme. So typically the diversification is still better, but it's not a pure diversified fund if you look at from a comparison to a multi-cap strategy, but still a good fund. Excellent track record, very good performance in this category, in this thematic fund, and you can actually hold on to it. But coming to your second query, you have just seen a 13-month performance. I'm assuming you are holding it only for the last 12 to 14 months, 13 to 14 month window. And in that period, the fund has done well. But when you talk about equity, you have to look at equity from a 5, 7, 8 year perspective, nothing less than that. And you yourself said that the markets went down, the fund also went down. So what did the fund do differently? Markets didn't do well in the last 3 months, everyone knows that. This one also went down. So you have to understand that this one, when it gives a performance, it has a potential to give you a superlative performance vis-a-vis the other comparative categories overall available in the equity markets. However, the vice versa also holds true. If the markets go down, this fund can go down more because it's particularly on one certain theme. So if that theme does not work well, if the consumption is not doing well, this fund will be a little more underperformer vis-a-vis the other categories. So you have to live with this. As a category, as a holding, you need to look at it from a 5-7 year perspective. And currently, I think in a country like India, consumption is a good theme, but you have to understand the extra risk it carries coming from one certain sector, one certain theme this fund carries. From my side, you can hold on to this fund, but definitely carries a little more risk, but can give you better rewards also.
Okay, we have two questions coming in from Padma Kumar Patil. The first question is, please suggest a good health insurance plan with the least waiting period for maternity benefit. The second is, how safe is it to invest through various robo-advisories? There are a few names that are mentioned, or other online mutual fund startups for direct mutual fund plans for a first-time investor. How safe is it? I think these are fairly regulated. They come under the various regulations of SEBI.
Yeah, of course. Let's take this first question only as the second question as first. I think, as you rightly said, Vivek, all these robo-advisory companies are reasonably regulated. They have all the required licenses in place. And more importantly, you are buying investments in your personal capacity, in your personal name. You're not doing a third-party transaction. You're not doing investments in their name. So they're not collecting money from you. So the investments are happening in your name only. So even if you have some concerns, the investments are owned by you, even if one of the advisory firms shuts down tomorrow. Okay? So even then, it's your asset, you own that, you can always do the transfer from one advisory firm to another advisory firm, there is no problem. So you can pick and choose which firm you want to go to, which one you like, which one has a better interface, and you can decide which one to go for. Coming to your other query of your health insurance and having that benefit of that maternity. Now most insurance policies on the health side offer you that benefit of maternity, but you need to hold for a period, and that's what your query is also. Typically you find any maternity benefit to be valid provided you hold the policy and is running policy for at least 2 years. So if you have a 2-year policy, typically you will find that maternity benefit being kicked in is available in that policy, but every policy carries their own terms and conditions. It's always good to check out that which policy you want to want to buy carries how much waiting period for some clause to kick in your case the maternity benefit. For example, like a Max Bupa carries a 2 years, Apollo Munich has the same 2-year waiting period. So please understand before you buy so that you are not disillusioned when it actually comes to taking a claim against it.
Okay, here's a question coming in from Saurav Biswas, and he's asking, hi Saurav, he says, I have 3 funds in my portfolio, SBI Blue Chip, Kotak Select Focus and HDFC Balanced Fund, and he's split this across large cap, multi cap and balanced fund respectively. Clearly, Saurav, you are doing a lot of your own homework and reading up, which is a very good thing. I need to know whether the fund categories of these have been changed or not.
The categories on these have not been changed, Saurav. All these 3 funds hold true to their nature and still carries the same stuff. However, you have mentioned SBI Blue Chip as a large cap, that's correct. HDFC Balance as a balance fund still holds true. Kotak Select Focus is not a multi-cap strategy, it is more of a large cap biased fund. So it's not a true multi-cap. So if you look at the percentage of large cap holding in this, a large component, I think it's more than 80-85% still being held in the large cap portfolio. So you will actually put this fund more in the category of a large cap and not a multi-cap. For a multi-cap, you need to have at least 30-35% in the mid-cap space to be truly called as a diversified fund, which this fund is not. I agree with you that this fund was typically called as a multi-cap, but it is actually not true right now. So you can change this fund only from this perspective. This fund is a good performer, has done very well, but it's more of a large cap biased fund. So if you want to look at a multi-cap strategy, do look at it different from that particular angle so that your portfolio is truly diversified. And otherwise, you can hold on to the fund which you carry in your portfolio.
All right, that's about all the questions that we have here today. And please keep sending us your questions. You know our Twitter handle. You can just go there, post your questions. We'll be more than happy to take them on the open house that we do here on Twitter Live. Thank you very much for
Thank you.
watching and see you soon.